Welcome to the big interview, our second big interview, our bigger interview, if you will, today. And it is with David Kotok. He is the chairman and chief investment officer at Cumberland Advisors. And if you want to get more information, cumber.com. He's on Twitter, or the firm's on Twitter, at Cumberland ADV. And I want to tell you a little bit about how and why David is here. You know, I ask you guys all the time to tell me when there's somebody you hear or you like someplace else, and you think, oh, if we gave him the long-form treatment here that we give on Money Life, things would be great. And so we got an audience suggestion that said, hey, I heard David Kotok on Bloomberg. I'd like to hear some more. And we certainly give folks more. But I will also tell you, if you want to learn more about him, the market commentary at the website, cumber.com, definitely worth checking out. I was not familiar with it. I've gotten a lot more familiar with it. I think you might want to do that too. Again, it's cumber.com, on Twitter at Cumberland ADV. David Kotok, welcome to Money Life.
Well, thank you so much, and thank you for those very kind words.
Well, thank you for joining us. And like I said, I always try to live up to it when my audience asks for someone, and it's my audience that said I needed to get you. So I'm glad that you're here. And I have to say they were right, because I really do enjoy the commentary that I've seen on your website. But we are right now living through some times that the return of volatility is making people nervous. They may not want to be nervous. I mean, nobody wants to be nervous. And they're not panicking, but they're edgy. Is that actually the right emotion, or is this not stop listening, because Lord knows we wouldn't have a job, but stop watching the market right now? This is not something to get upset about and let your blood pressure rise over.
Well, the investors, market agents, have had a period since the financial crisis. So let's think of it as 2009, 2010, in which interest rates were kept very low. We had an economic recovery from a very low, extreme recession, in which not only did the economy turn down in a strong, forceful deterioration, but at the same time we had a financial crisis and a housing debacle, and banks failed. And you think about what took place 10 years ago, 11 years ago, and we haven't had anything like that since the Great Depression era. After such a shock, there's a period, and history will reflect this everywhere, there's a period of time in which inflation stays low, things are calm, the recovery is coming back from a deep hole, and therefore it has unused capacity, so you don't have inflating pressures. Jobs are created slowly, and therefore you have excess labor force. And the survivor bias of companies and businesses applies, because the ones that didn't survive aren't around anymore. And therefore, you have this period of calm. We have had that period of calm probably 6 or 7 or 8 years. And we've had the memories of the shock since the shock arrived, really in the end of 2007, but certainly 2008. So that's where we are. Now, things are restoring to normal. Interest rates are no longer zero. Interest rates in the bond market are higher. Interest rates in the tax-free bond market are higher. Mortgage interest rates are higher. A person can earn a couple percentage points on cash. And therefore, markets are beginning to normalize behavior after a period in which they lulled the investor class into this sense of low volatility. I'm an old dog that's been in this business for a while, and I remember volatility like this. It's more normal, and we're restoring whatever is the new normal or normal number 2 or whatever the nicknames are. That's where we are today.
It's funny because yesterday we had Michael Mullaney, the global research director at Boston Partners, on, and he almost verbatim was saying we're getting back to normal. This is not abnormal. This is the norm. What's been abnormal is what we've been through. And that's the way you have laid it out. But the flip side of what we have been through that hasn't been normal is this uninterrupted bull market and the expectation it creates for investors. So are the expectations for normal returns going forward, normal being 8 to 10% long-term on stocks, or are they for something that we have to maybe shake a little bit of the 9-year bull market off? I mean, what's the logical thing to happen here? Because we know that as rates rise, you can get enough economic pressure to create a downturn or a recession. We haven't seen it yet, but we could.
Well, this is true. I think that's in the hands, in part, of the Federal Reserve as to the pace at which rates rise. And this Fed has been very gradualistic in its methods. It might have been bashed by the president along the way. That's political rhetoric. The fact is, Jay Powell has been on a very predictable course, and the Federal Reserve has broadcast well in advance what it planned to do, when it planned to do it, and what it was considering. So I think that path of rising interest rates is a gradual one. That's the first issue. The second issue, and I'm sorry to be boring by reporting or repeating what transpired with your previous guest, but the fact is, normalcy is a good thing, and correcting expectations which were too high, I believe, was a needed thing for stock prices and also for bonds. Both are now in a better place. So if you say, what do you expect returns to be in the future? I would say some mid to high single-digit expectation is probably appropriate for an investor. And if you say, what do you think the bond yields will be? My guess is we're seeing high-grade tax-free bonds somewhere around 4%, depends on where you are in the country. We see taxable securities above 5%. We see mortgages above 5%. Those rates may go a little higher, but they're not going to go a lot higher unless we get some external shock.
How much do you worry about external shocks, and how much is it just headlines and kind of chatter? I mean, the funny side is that we keep hearing the phrase fake news used in this country, and it sometimes is applying to news. When we talk about things that are happening in the stock market, it's never used, and yet many of the things we worry about are kind of fake news when it comes down to their ability to impact the market. How much, if anything, do you worry about the headline risks?
Well, headline risk has certainly impacted this market. The trade war rhetoric is horrible. The president's style is belligerent and something we're not used to in terms of behavior. There were other leaders of the United States in its couple-century history that had styles which might have been offensive. But this one really is a shock. And the shock has introduced polarization, and that's one of the negative things that's come out of this political mechanism of ours. We have a great American democracy, but we are a divided nation. And we are now acrimonious and rancorous when it comes to that division. So that's the headline risk. I think you got to look beyond the headline risk. Take it for what it is. We don't have to like it, but we have to accept it because it's here. So one has to look at the substance. And I think in the substance, there's a greater worry because of the trade war. Remember, we started rhetoric in the trade war in the early part of this year. Think of it as, say, January, February. The first introduction of tariffs was on 13 items in aluminum and steel. Look at where we are now. This has been progressive and destructive because trade wars do two things. They have the impact of a sales tax. So the Trump administration, in its trade war, has essentially placed a sales tax on our own constituency in the United States. And the retaliatory actions of other governments placed a counter sales tax on their constituencies. No one wins. There's an old expression in economics. In a real war, the guns are pointed at each other. In a trade war, the guns are pointed inward. So you think about what we launched this year, how it has affected economics globally, introduced risk, raised inflation expectations, and restricted possible productivity gains. Why? And therein lies one of the reasons markets are growing more and more concerned, because markets and market agents for a while said, well, this is temporary. This is political rhetoric. This is sort of scary stuff. But as a practical matter, it's not going to go on. And now markets are worried about the fact that it may go on, because they're not seeing the U.S.-China, the first and second largest economies in the world, coming to any direction that would suggest a settlement, a truce. Now we have this conversation. President Trump and Xi Jinping will have a sidebar meeting soon, next month. Will there be some movement? I don't know. I would say if that were to occur, if there were to be some resolution, our markets would like it, China's markets would like it, world markets would like it, because they will be getting beyond this trade war stuff. We haven't even resolved Mexico and Canada yet. We got a deal. But Mexico says until we resolve the other tariffs, I'm not going to sign. And on December 1st, there's a new regime in Mexico, and the political process would have to start all over again in that country. So we have an unfinished piece of business, and in the event it's not finished, the social and economic penalties in many countries can be very severe. That's one of the reasons this market is worrying.
We're almost out of time. But another reason why this market is worrying has simply been, it's not headline risk, it's just, maybe you call it technical analysis risk, something along those lines. So here we are talking for Halloween Day. And if the market goes down today, it would be the 17th down day in October, which would be the highest number of down days in a month since April of 1970. Now, stats like that keep coming up. I don't raise them, but I do see them. And I raise them in an interview like this with one question in mind. When people hear stuff like that, like, that's interesting, but it's not actionable, and just shake it off, right?
October is a notorious month for trouble in the stock market. That's an established fact. History bears it out. You just cited one example. So do you make decisions going into September and October to have a cash reserve, to recognize risk? In our portfolios, we did. We do that every year. We need to have a very strong case not to do it. What do you do in November and December? The history would suggest the opposite is going to occur. I think we're going to have a year-end rally, and I think the S&P, before this is over, at the end of the decade, will be above 3,000.
And so Santa Claus is coming to town, we hope, in the form of a rally and long-term direction, markets up. A return to normalcy. I love the message. David Kotok, this has been a pleasure. Thank you for joining me on the show.
Thank you. It's my pleasure to join you.
David Kotok, everybody. He is the chairman and chief investment officer at Cumberland Advisors. It's cumber.com and on Twitter at Cumberland ADV. And if you like this information beyond this interview, beyond going to get more information from his websites, remember, this was an interview suggested by one of you. And if you want to do more of that, Chuck at MoneyLifeShow.com. I'd love to hear your suggestions, your questions, your picks for hold it or fold it, whatever's on your mind. We'd love to hear from you.